Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So that being said, let's say, for example, we were looking at creating a straddle on the CDD, and as you can see here, as of on Monday, the CDD was actually trading at 105. Now, the CDD reflects the U.S. dollar as a base currency against the Canadian dollar, so we're in fact trading our directional views on the U.S. dollar and whether we think it's going to go up or down against the Canadian dollar. Now, in this particular scenario, we may believe that the CDD has been particularly range bound over a certain period of time, and we feel, based on our market outlook or based on our currency outlook, that there has to be a move. Something has to give. In other words, this particular pair value can't trade sideways forever. They can do it for an extended period of time, but at some point you would assume that a decision has to be made with respect to a breakout in either one direction or another. So looking at it from that perspective, we would look at the 2-month 105 call options, which are asking $1.92. We would also then take a look at the 2-month 105 put options, which are asking $1.64. Now, there's always going to be a discrepancy in the call options versus the put options in terms of their pricing, so you'll never ever find yourself in a scenario whereby the call and the put options, both of the same strike and expiration month, are going to be trading the same because of the other factors influencing the price of the option contract. But recognize in this example, as of Monday, these were the prices of those particular option contracts. So what we could do essentially is buy a 105 call at $1.92. We could then go in and buy a 105 put option at $1.64, and the net cost of that position is $3.56. Now, this represents the maximum risk of that particular strategy. Now, John just had a question. It's a little more advanced for some folks, but why would you want to sacrifice the gamma by splitting your expirations? And that would be referencing the impact that a stock movement is going to have on the delta and the impact on each of the option contracts respectively based on a stock move. Well, John, my rationale under those circumstances is that I don't have a neutral bias on the stock. I'm not expecting a move either up or down. I have a directional bias that extends out maybe 4 or 5 months, and I want to hedge my immediate risk by using a near-term option contract. So my rationale is not to make money on a move to the downside, for example. It's more so just to offset the immediate risk of an adverse move while still looking to participate in a longer-term extended move out of the to the upside over a certain period of time. So that would be my rationale with respect to splitting the expiration dates. Hopefully that sufficiently answers your question. But in this particular scenario, once again, we're looking at buying the 105 strikes. So we're buying a 105 call, 105 put. Net cost is going to be $3.56. $3.56 reflects the maximum risk on this particular strategy. Now, we have to recognize that because we've purchased both the call and the put option here, the cost of this transaction is going to be that much more than if we just simply had a directional bias and bought either the call or the put separately. So in order for us to determine the break-even point on expiration of this particular trade, we have to take the entire value of that position and add it to the 105 strike of the call, which equates to 108.56. We also subtract it from the 105 strike of the put to determine our downside break even, and you can see that it's 101.44. So what this suggests to us is that if we look to hold this position from now until the expiration date, we would need the pair value to either be above 108.56 or below 101.44 for us to make money. What we have to realize is that we do not necessarily have to hold this position out until expiration. We can also make a determination throughout the life cycle of this particular trade as to whether or not we want to offset the one side early and recapture as much of the premium that we've paid on that one, and then continue to enjoy profits on the continuation of the trend in the other direction. So we don't have to hold this position right out until expiration. We can manage it throughout the life cycle of both these option contracts to essentially reflect a particular directional bias once the move's underway. But that being said, here's a chart of the CDD here, and as you can see, what we would be looking at is, in a sense, buying both the 105 strike call and the 105 strike put. You can see that the stock was essentially, or the pair value was essentially trading within this range at the time that these prices were actually looked at, and you can see that our break-even points on this particular transaction appear as though they're quite a ways away. Remember that ultimately that is because of the fact that we're looking at it based on the expiration. Now, I think maybe that references Sal's question that it's a far out upside profit area. It's above the range over the few months. So the idea is that this would have been perhaps a nicer trade back when the pair value was around 103. The 103 level, and absolutely, I mean there are certain elements of timing that one needs to really look at when it comes to establishing these types of transactions. But I would argue that if the trading in and around that 105 level, looking particularly at what the CDD is doing from a technical perspective, we have once the move to the upside is underway, the 108 to 110 range is very attainable. Similarly, we know from past historical references that the CDD has also traded down towards the par level, and so. At this point, we're really more or less mid-range between 110 and mid-range between 100. Now, what we have to recognize, of course, is that I've illustrated the profitability of this transaction based on expiration. But what I want you to recognize is that if a move to the upside is underway immediately, understand that the rate of profitability will be accelerated in the call side. You'll still have you'll definitely see a deep depreciation in premium on the put side. But if you're confident that the trend is underway, you can offset that put position and continue to hold on to that call position. And what you've essentially done is you will have lowered your break-even point on that transaction once this put option is off the table. Similarly, you can do the same thing if the move is underway to the downside. Ultimately, what you can look at doing is offsetting that call option early. The other consideration, of course, is that if you are considering, of course, the net offset value of this particular transaction. So in other words, you may be losing somewhat on the put side, but that call option based on an expansion of volatility and an appreciation in the premium based on the intrinsic value being generated should net you out a profit, even though you haven't reached your break-even point.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.